All right, let's be honest. You've seen it on a financial report, right? That term deferred tax. And if you're like most people, you probably just kind of skip right over it. But what if I told you that that one little line item actually holds some really juicy secrets about a company's future? Well, today we're going to pull back the curtain and demystify the whole thing. So, the whole idea of deferred tax really boils down to this one kind of weird puzzle. How is it possible for one company to have two completely different profit numbers in the exact same year? I know, it sounds a little strange, but trust me, it happens all the time. You see, there's one profit figure they show to investors. We call that the accounting profit. And then there's a whole other number they show to the government, the taxable profit. So, what's going on here? How is that even possible? Now, before your mind jumps to complex loopholes or shady accounting, the answer is actually really simple. It all comes down to one single word: timing. Yep, that's it. It's all about when the company officially recognizes its income and its expenses. Okay, think of it like this. A company has to play a game, but it's got two totally different rule books. The first rule book, that's for the accountants. Its goal is to give investors a really clear, honest picture of how the business is doing. Then you've got the second rule book, written by the government, and its only job is to figure out exactly how much tax the company owes. And here's the kicker. These two rule books, they don't always agree on when to count things. And that is exactly where deferred tax makes its grand entrance. It's basically the bridge that connects these two different worlds, these two rule books. It's super important to get this. We're not talking about the actual cash the company pays in taxes today. Nope. Deferred tax is just an accounting adjustment, a note to self that keeps track of the tax they'll either have to pay or get to save down the road because of these timing mismatches. Okay, so let's get practical and see how this whole timing difference thing actually works. It basically creates two characters in our story, two key items you're going to find on a company's balance sheet. Right, so deferred tax splits into two main types. You've got your deferred tax liability and your deferred tax asset. Just think of them as two sides of the very same coin. One is basically a future tax bill, and the other, that's a future tax break. Let's talk about the deferred tax liability first. The easiest way to think about this is like an IOU note written to the taxman. It happens when the tax rules let a company pay less tax right now than you'd expect based on their accounting profit. A classic example is depreciation on an asset. The tax law might say, hey, go ahead and deduct a big chunk of that asset's value this year. This gives them a nice, lower tax bill today. But, and this is a big but, it's not a get-out-of-jail-free card. They're just kicking the can down the road. And then you've got the other side of the coin, the deferred tax asset. Now, this is the good stuff. It's like having a gift card or a coupon for a future tax refund. This happens when a company actually pays more tax today than its accounting profit would suggest. For instance, maybe their accounting rules let them book a provision for a future loss, but the taxman says, nope, you can't deduct that until the loss actually happens. So, in a way, they've overpaid their taxes for now, knowing they'll get to claim that benefit back later on. Okay, analogies are great, but I think it's time to crunch some actual numbers to make this crystal clear. Don't worry, we're going to walk through a really simple example, and you'll see the math is actually super straightforward. So, let's imagine a company. Here are the key numbers. Their accounting profit is ₹1,000,000. The tax rate is 30%. Pretty standard so far. But look closely at the depreciation lines. For their accounting books, they've got $200,000. But for tax purposes, $300,000. Ding, ding, ding. That difference right there is where all the magic happens. So what's the deal here? Well, the tax rules are being a bit more generous this year. They're letting the company claim an extra 100,000 rupees in depreciation. This is great for them right now because it lowers their taxable income. But it's only for this year. And that 100,000 rupees, that's our key figure. It's what accountants call the temporary difference. And the word temporary is crucial here because eventually, over the life of the asset, this difference will balance out and disappear. That's why we have to keep track of it now. So how do we turn this temporary difference into our actual deferred tax number? It's literally just one step. You take that 100,000 rupee difference and you multiply it by the company's tax rate, which is 30%. And what do you get? 30,000 rupees. And there it is. That's our deferred tax liability. It's the amount of tax they got to skip paying today, but will absolutely have to pay in the future. It's that IOU to the tax office we were talking about. Okay, so we've covered the what and the how. But now we get to the most important question of all. So what? Why does any of this actually matter? Why should you, as an investor or just someone curious about business, even care? The biggest thing to remember is the difference between now and later. Current tax? That's the real deal. It's actual cash leaving the company's bank account to pay this year's tax bill. But deferred tax, that's different. It's not a cash payment. It's purely an accounting entry, a placeholder for tax bills or tax breaks that are coming down the line. And this is exactly how you'll see it laid out in a company's financial reports. That deferred tax asset, our refund coupon, shows up on the asset side of the balance sheet. And the deferred tax liability, our IOU, sits right there on the liability side. The change in these numbers from year to year is what actually hits the profit and loss account.
At the end of the day, the whole reason we do all this is to follow one of the most important rules in accounting, to give a true and fair view of the business. By creating deferred tax, we're matching the tax expense to the period where the profit was actually earned. It just smooths everything out, getting rid of the weird bumps caused by those two different rulebooks, and it gives investors a much better sense of a company's real underlying profitability.
So let's circle back. Why should you care? Because deferred tax is like a secret window into a company's future. You see a huge growing deferred tax liability? That could be a sign that a massive tax bill is just waiting around the corner. On the other hand, a big deferred tax asset? That might tell you the company is pretty confident it's going to be making a lot of profit in the future to use those tax breaks. So the next time you're looking at a financial statement and you see that deferred tax line, don't skip it. Stop and ask yourself, what story is this number trying to tell me about where this company is headed?